let's get on board with a fundamental analyst of the show, Anirudh Garg, partner and head research at Invasset PMS. Anirudh, so good to have you on the show.
Thank you for having me. It's a pleasure.
Okay, Anirudh, let me start off with just an overview of the markets. We saw a bit of a pullback from the last two trading sessions. So what does it mean for investors? Is it time for them to be more conservative?
I think from where we see that overall the markets are not in a value zone now. I would go to an extent of calling them that the markets have entered an expensive zone. So whatever the money that has been made in the past couple of years from June 2022 till today, I think the focus of the investors should shift now from creation of wealth towards preservation of wealth. So all the signals like which normally people trade like breakouts and going and buying whatever they like, I think there should be some halt in that going forward, because this is what expensive markets do. This is what expensive valuations do. And somewhere down the line, not right now, but we feel somewhere down the line we are in for a bull market correction. And whenever the correction comes, you can see the large caps falling by 20%, the mid and small caps falling up to an extent of 30%. This is what the bull markets in India, in an old economy run, are primarily characterized by. So yes, it is a time that you take a breath and rejig your portfolio and make it an optimal combination of those small and mid caps where there is no exuberance, and on the other hand, have a majority of your portfolio in the large caps, right, according to us.
Okay, majority of the portfolio in the large caps. But you mentioned that 10% fall is warranted for large caps, 20 and 30% for mid and small caps. So this correction, when do you expect this to happen? Do you expect is there a certain timeline in your head?
So it's very, very difficult. I have not seen anybody in my 17 years of career whose timelines have come correct. You may be correct from time to time, but it is like same as you do in a casino. But overall, that expensive market valuations, they are bound for two types of corrections: time and price. And I believe somewhere in the next 3 to 4 months, we should be seeing something like that. But yes, I have the right to be wrong, and we may be in a structural bull run that nobody can anticipate, because India is going through that $4 to $10 trillion economy mark. But looking at the overall participation in the market and the way the expectations of the investors towards the stock market has changed in the last 5 to 6 months, we believe that somewhere there is some degree of caution that needs to be exercised. If you have a 3-year view, then you are perfectly. Indian stock market is the best place to be. But what happens during the top of the bull runs is that I have seen that people come in with a 3-month, 1-month, 2-month view, with a very, very short-term view, and then the entire purpose of investment is defeated. You have to come in at least with a 3-year view. And this 3-year view is something, if you keep, then Indian markets are the best asset class to be. Please, I would request the investors not to come in with a gambling or a trading view for the next 2 to 3 months.
All right. Okay, Anirudh, you mentioned about the correction. We talked about it, but in an overbought market, the biggest risk is always what is unknown for the markets. So, what do you think? What is the next big risk for markets?
See, I have never seen anybody predicting a risk before it actually comes into the market, and when that risk becomes evident is where the bottoms are formed. So see, very, very difficult for the markets just need a reason, a particular type of fear which can be extrapolated by everyone. As was the case in COVID, everybody thought that everybody's going to die, the stock markets are going to finish, and we saw the major bull run from here. The same happened during the Russia-Ukraine war, where there was a threat of a nuclear war coming up. So these things come from time to time, but the fundamental of it is that overall the markets have become expensive on a historical valuation basis. So we have to keep that figure in mind and take all our decisions not based on when it will happen or will it happen or not, but based on the factor that we are in expensive markets and we need to design our portfolios accordingly.
Okay, all right. But the one more question is that Israel's attacks have been stepped up. There's escalating tensions in the Middle East as well. Right now, the oil markets are not pricing in the complete risk of the escalating tensions in the Middle East because Saudi Arabia is also indicating that they will be going on for a production hike as well. But for the near term, can we expect certain risk from the Middle East tensions to trickle in for the markets as well, or are we going to completely be aloof from it?
Absolutely. There can be, as I told you, there can be any reason. The reasons are just made up from time to time. And stock markets, especially Indian markets, which have amazing demography, democracy in place, government working, initiatives in place, new schemes coming up, we recover from all those problems from time to time. But yes, as you rightly said, that this can be one possible risk, but it is very, very difficult to say what that risk will be. See, the Japanese yen carried rate correction that came into the markets, nobody expected it to come. Predicting it. The best of the institutions were borrowing in the Japanese yen because of the low interest rate. So these problems come from time to time and very, very difficult to predict. Myself, I personally never been able to predict them for the future. But yes, overall, if you take a cautious call, I am not saying that don't invest in the Indian markets or take off your money from the table. It's a very long-term phenomena that we are opting for. But I've recently seen a lot of investors coming in with a very, very short-term period because looking at what returns have been made in the past 1 year, I can guarantee this: the returns that have been made in the past 1 year for a lot of PMSs, mutual funds, and AIFs in the last 1 year, including ours, will not be made in the next 1 year. So one needs to take a bit of caution that stock market is not it's not a tree where you can go and pluck money. It is a very sophisticated asset class, and that asset class is one of the best out there. So you need to treat it that way, and if you have the right horizon and the right perspective to invest in the stock market, if you know that the Nifty does 12 to 14 in the long run, and you wish for something like a 15 to 16, and if you have a better strategy, you wish for something like a 18 to 20, yes, then the stock market is the right place for you. This is what I want to convey through this interview to our dear investors.
Okay, Anirudh. But Anirudh, you also mentioned that PMS managers, fund managers, if they take a longer term view, and in probably in the next year, they could see some moderation in returns. But what can be the standout sectors which can outperform the benchmarks as well? Anything in mind?
See, so overall, let's analyze the last 2 years. The last 2 years have been we are primarily in an old economy run. An old economy run is something which focuses on value, but the new economy becomes very, very expensive. Now, with the time correction and price correction in the new economy, we have seen that they have also started giving value. So we see a lot of value in good private sector banks now. There is value in metals stocks, as we see that the era of the interest rate hikes is over, and now we are looking for rate cuts over time. And somewhere we see that the global growth is reviving. I believe that the auto sector particularly has become very, very expensive, and based on historical valuations, we feel that it is not something to be overly bullish on, though you may have companies and which are differentiated on technology from over time. So yes, autos we feel have become expensive. Real estate we believe is still there to continue. So overall, the global growth revival is what everything depends upon, how China revives. And I believe with the steps that the countries are taking place, the central banks all over the world are taking, somewhere we feel that the global growth will revive in the next 6 to 8 months, and then another bull market will begin with the interest rate sensitives, both global and domestic, going forward.
All right. Anirudh, you also mentioned that China is also stepping up their stimulus measures as well. But given that China's comeback is on the horizon as well, but I don't know if it is on the horizon because the stimulus measures also can take quite an effect, ground reality check, the magnitude of it as well. But given that the steps have also been taken up, so will that take away the FII flows from India? Do we expect, given that we're already at an expensive valuation and China is relatively less expensive from India, Can we expect certain FII flows to get diverted away from India?
See, temporary shifts can always be there. That is the part of equity markets. Um, Temporary shifts can always be there, but you have to compare apples and apples, and we cannot compare apples and oranges. India is a democracy, and democracy is what resonates trust. So the lack of democracy in China, we'll never be able to compare it with India. When we compare India, we have to compare India with the US, and then when it compares with the US, we have to look at the growth rate differential between the two countries. So I do not think that on a longer term horizon, the flows from India will shift to China. And Indian markets have a nature of being expensive. They have been expensive for the last 17 years of my career. I've never seen people saying that Indian markets are now trading at valuations which are very, very cheap. So I think that is something that is not to be worried, and I don't think for a longer term horizon, over a 6 months horizon, I do not see flows going into China because of the lack of the trust of the democracy there.
All right, lack of the trust of democracy. But Indian equities, they have been trading at expensive valuations. But at this point of time, do you suggest that traders could also increase certain allocation towards gold? Because every central bank around the world has also been on the rate cut cycle as well. Does this mean that the gold at this time will augur well for investors?
I think so. That gold should be a good investment going forward. You should have a certain portion of your portfolio in gold.
All right, certain allocation towards gold. But Q2 results are on the horizon. Anirudh, any sectors that are expected to stand out? We saw a tepid performance in the first quarter as well.
See, we expect the second quarter to be on the same terms. But yes, going forward from Q4, we believe that whereas the growth is expected to return. And so, yes, the sectors, as I already told you, will be the sectors which have tailwinds with them, particularly real estate, metals going forward as the rate cycle is reviving, and pharmaceuticals and FMCG defensives should be good as they turn better alternative investments in expensive markets. So all the defensive pack should be all right for the next 3 to 6 months.
All right. Defensive pack should be all right. But Anirudh, thank you for taking out time, sharing your valuable insights. We hope to connect with you soon as well.
Thank you. The pleasure is all mine.
All right. All right. Let's just